Welcome back to the Finance Corner. So this is going to be first market review, and then kind of just winging it here, and then we're gonna go and improve this as we keep this going. But I'm gonna try to get this done at least once a week, at least once a week. We got just so we see what's going on with the market, how things are moving and grooving, and yeah. So I guess let's first start off with the heat map. Yeah, we can start off with the heat map. So if you don't already know what the heat map is, Standard& and Poor's 500 index stocks categorized by sectors and industries, and the size represents the market cap. So the bigger the box that you see, the uh, the bigger the company. So you can see like Nvidia kind of has the biggest. It's the highest market cap company on the market right now. So you can see it has its the biggest box. But so what we're seeing right now is technology was getting hammered this week. So this is the performance for the past week. So Microsoft is down 6%, Oracle down 6%, Palantir, CrowdStrike, and then in the semiconductor space, Nvidia is down 3%, ABGO, MU, Micron down 15%. Yikes. And then we got AMD kind of flat. Intel, I forget it was Texas Instruments. Yep, the people who make calculators. They are, I think they do a lot more, but we can look into that at a different point. And then what else we got? Consumer cyclicals. So we got that's where you get your Amazon, your Tesla, and stuff like that. Google's and Meta is getting hit. Google and Meta got hit like crazy this week. See Meta down like 12% roughly. Google down like 8% roughly. You got Verizon. So I'm surprised that telecommunication services are actually doing. They actually didn't do too bad this week. Uh, they didn't do too bad this week. Entertainment, not bad. And then we got our micro subsectors. But one thing I wanted to point out with this is that do you see what sector has the biggest like actual gain? So we got the technology with the biggest losses, and then we see energy actually have the biggest gains. And part of this is because of obviously the war. And like it brings me to the saying that there's always a bull market somewhere. There's a saying in the market like our investors amongst investors on Wall Street. It's like there's always a bull market somewhere, because like most people like to just invest in technology companies overall because they've been doing very well over the past, at least decade. Technology companies have really been doing well, but it's like technology doesn't have to be the number one investment always. It's like a lot of the times when they do these valuations of these tech companies, like they're not actually profitable yet, but they're priced as if they're priced for perfection in a way that like everything that they plan on doing it's gonna happen. But as of right now, nothing's happened, and so these companies, these tech companies, really sometimes aren't really your best investment, right? And then we can also see take a look at healthcare real quick. Not too bad overall. Eli Lilly down, Johnson up, Abivai, what is it, MRK, Merck and Co. And then yeah, not doing too bad. Medical device, but look at how well energy is doing overall. Energy and utilities. So these are some good companies that you can probably have part of your portfolio to be diversified. You don't have to be 100% tech. So yep. Overall, can we see? I want to see if shows like the actual percentage for the. Nope, I think I gotta do that myself. Maybe we can take a. We're gonna take a look at some charts as well. I'm gonna try to keep this brief and as informational as possible. Let's see. So that was the S&P 500. All the top 500 stocks on the stock market, and then we got the Dow Jones Index. So you can see this is mostly all red because there's a lot of technology companies in here, and then Walmart, Coca-Cola, and some other big dogs in here. But Dow Jones is getting hit pretty damn hard. As you can see, remember, the bigger the box, the more like weighted it is in the index. So, it's the Dow Jones 30. Nvidia and Apple has a big weight in the index. So is Amazon and Microsoft, and they're all down. So you can expect how the Dow Jones is looking. Take a look at the Nasdaq real quick. So this is purely tech companies. Purely tech companies, and you can see mostly red, mostly red. So now this is something that is interesting to think about. Walmart is part of the Nasdaq. I didn't know that. And then this is Costco. Costco and Walmart's part of the Nasdaq. Didn't actually know that. I mean, it is 100 companies, so it's like that kind of makes sense. I don't know every single one, but interesting. I learned something new today. So the Russell 2000 actually just shows the it's just the small cap stocks, and you can see there's a lot more companies in here. It's literally 2,000 stocks, but these are all smaller cap companies. I forget the actual cutoff for the market cap. I want to say like less than 500 mil, but we can actually look that up. Actually, look that up real quick. What is the market cap requirement for Russell 2000? So we got, see, Russell tracks 2,000 small cap U.S. companies. Okay, so companies have a market cap of at least 300 mil or more. Index represents bottom 2,000 stocks. There you go. I thought it was anything less than 500 mil, but I guess the bare minimum is 300 mil. And then I guess that would make sense, right? Because anything less than 300 mil might be just considered a penny stock. So, yep, there you have it. So, let's see. Kind of had a structure for this a little bit. We can also kind of take a look at any economic data that we got that was really important. But first, before that, today's Friday. I'm gonna try to record these maybe on Fridays or Saturdays, and get them going over the weekend, so we have something to look forward to on Mondays. So, anyways, the fear and greed index. This kind of measures like literally the emotion that's driving the market right now. As you can see, fear is it's extreme fear. Extreme fear. Like people are like losing their minds. They're like, oh my God, it's the end of the world kind of thing. Like, I think if I had a historical reference for like COVID, but it's very close to COVID levels kind of thing. So you can see, oh, maybe you can see the timeline. How far does this go back? Okay, not that far. Not that far. All right, it's all good. So you can see the lows we actually had was last year, 2025, April. We had an extreme fear of like 4. So you can tell, or we can actually even see that on the chart, how low stocks went when there's extreme fear in the market. So we can expect a lot of volatility. We can expect a lot of volatility when it comes to the overall market. When with fear driving its main, fear being the main driver, you can see how look at how much the market's been selling off lately, or at least just look at today. Today is Friday, the 27th, and the market dropped. You can just easily measure this right here. So S&P 500 actually dropped 2% in the day, which is crazy. It's actually, put that into perspective. Like, right, the biggest companies on the market is weighted in this index, and it lost 2%. So that's a lot of money. That's a lot of money. That's some people's retirement accounts are involved in this, right? So that's where we have it. But here's also how I want you to think about it, where typically the way it goes, or the rule is, during extreme fear, when there's fear in the market, you want to be greedy. And when there's greed in the market, you want to be fearful. So where we are in this cycle means you should be kind of looking forward to picking up some shares. You should be looking forward to adding some positions, even if you're down, probably add to the position so you can lower your cost basis, and then everybody's happy. So yeah, like back in, we've seen that in 2025, April, how low the market went during extreme fear. remember we were at like 4. I think it was the date was like April 7th. So you can see, but like I want you to think about, imagine if you were buying, if you were actually buying in this area when everybody else is selling off. I think this is when Trump announced his Liberation Day, and he was like, "Oh, we're gonna, the tariffs, and everybody's getting tariffed," and like the market was like, "Oh shit!" Like I don't know how to respond to that. But imagine if you just cut out the noise and you're just like, you know what? If stocks are on sale, let me actually buy. So imagine if you were a buyer of stocks in during this time, you would have seen. Let's see, zoom this out a little bit. Like look at the amount of upside that you would have seen before we're starting to come back down here. But look at the amount of upside you could have gotten in just a matter of a year. Even less than a year, because we're not even in April. We're about to hit April, but April 2026. Like even in less than a year, you could have got 36%. And this is if you bought the whole entire index, right? So imagine if you bought something like, well, you would have to have a thesis for why you would buy an individual stock, but it's like if you want to keep investing as simple as possible, you just buy the whole index. And if you timed it correctly, when everybody else is fearful and you actually bought, you could have been up a good 30, 38%, 40% on your money in less than a year, and then you're chilling. Like that's crazy because the market on average returns 8% in a given 10-year span. You can expect like an average of 8% return. You know, so it's like okay, this is kind of where we're at right now, and a big reason for why the market's so fearful right now is because we know the war. We got just some of the developments that I know is going on. We have like the Strait of Hormuz is closed, so that is a very big deal because like a good 20% of global oil supply goes through that strait, and Iran is like, nope, we're keeping it closed. No shipments are going through, and if you try to um, ship through here, we're just gonna blow you up, right? So people, energy is such a very important part of the economy. Like every single aspect of business and everything has energy embedded into it. So you know, energy is very important. So this is why the market is kind of selling off, and because we don't know exactly how we're going to navigate this going forward. Like if the strait remains closed, the longer the strait remains closed, is the worse that things can get, and the more expensive gas prices can get, and the more the market. And this is kind of what we're seeing or being reflected into the market right now, where the market is just selling off like crazy. Like this is actually a very big day. Like today on Friday, just selling off like that. It's gonna be interesting to see how we are in the next week going forward. But as you can see, everything on my watch list is like pretty much red here. Everything is pretty much red here, right? Except for energy. Except for energy. So let's see. Next, we can talk about some economic releases. So we're gonna briefly discuss, I guess, anything that happened relevant this week. I mean, there's a lot of data that always comes out. Like, I'm not going to sit here and just go through every single one of them because then we're going to be here for 4 hours. So let's see. Let's go to. I don't want that part. Just calendar. So give me the up to date. Okay, so that was this week, Monday the 23rd. Let's see. FOMC member, consumer confidence for the euro. It's also very important to pay attention to which currency you're looking at. We live in or at least I live in the United States, so I'm going to be paying attention to United States news. Unless, you know, if you live in Australia, then, you probably want to pay attention to CPI. It's pretty important. It's an inflation number that will tell you what the central bank will be doing. Or if you're even in like a forex trader and you're trading the Australian dollar, I want to pay attention to what's going on in the macro economy there, right? But to be honest, let's see. I don't see anything extremely significant. This is a lot of yellow folders. Let me do this real quick. So, I mean, we really didn't get any significant data. Oh, unemployment claims. This is actually pretty important. So we had what was the data here? Previously, it was 205. They forecasted, excuse me, previously it was 205, so 205,000 people filed for unemployment. Excuse me. They forecasted for the number to be 211,000, but they actually got 210,000, which is less amount of people than they expected filing for unemployment. So this is actually, if you're looking at it in terms of how this data will affect the federal funds decision, I mean, to be honest, it kind of looks uh, like this is not a bad run. This is not a bad number actually. Um, this is a surprise, but it's a surprise to the downside. What you don't want, right, is more and more and more and more people. So if the forecast was 211 and this number came out at like 250K, that would be a problem because then they didn't account for like 40,000 people who's filing for unemployment, right? But just to tie this all back together, it's like the Fed has a dual mandate, and one of their most prominent tools is the federal funds rate. So they're going to adjust interest rates to be able to, fulfill their dual mandate, where they have maximum employment and price stability. So maximum employment means keeping the unemployment rate as low as possible, while also not making inflation go out of whack, right? And so these are the numbers that they look at. So these are kind of important. So we have a revised consumer sentiment number, and now this is also kind of an important number because when we think about the American consumer, like this is why we always need to have a little bit of inflation, because the consumer is what drives the economy. If people are not spending money, we're not growing as a country. So we kind of have to have a nice balance between, you know, consumer sentiment and all these other economic factors. But looking at the number here, so previous was 55.5, they forecasted 53.9. So they did account for, or they forecasted a drop in consumer sentiment. And just so you know what it means, it's just like a confidence indicator of the consumer. So the higher the higher consumer sentiment means the consumer is more confident in spending their money, and then they're them being okay. So you want this number a little bit higher, because like a strong consumer means that's like good for the economy. Now they actually seen that the consumer is weakening, right? Because they forecasted 53.9, but we actually got a little bit lower. So let's see. So we can actually think about how that's going to affect the next Fed funds rate. So I'm going to come back to this, and then we're briefly just going to discuss where we are with the interest rates. And then towards the end, I'm just going to look at some charts, and we'll see if we're at some key levels or anything like that. And then that'll be it. That'll be it. So if this thing will load. So our next federal funds meeting, we recently had one at I think it was like March 18th. But the next Fed funds meeting is at the end of April, which is literally about a month away from now. So our current federal funds rate is 3.5% to 3.7. So it's actually interesting. I think that in the last Fed meeting, if I remember correctly, I gotta do more research on this. But I think in the last Fed meeting, they said that they were going to keep, like Powell is planning on cutting, unless they've seen some type of data that shows that they shouldn't cut. But this is interesting because the market is pricing in they're not going to cut. Actually, they're actually pricing in keeping rates the same, and also an actual increase in the rate Fed funds rate. Very interesting. So just so you understand the correlation here, a lower Fed fund rate means yields are lower, so money is less expensive. Money is less expensive, it's easier to obtain capital. If it's easier to obtain capital, businesses can do more shit, which is basically good for money, good for stocks. So when the interest rates come down, it's actually a good thing for stocks. You usually see, stock prices go higher. But this kind of falls in line with what we're seeing on the price action in the indexes, where we're actually coming lower because it seems like the market is pricing in no rate cut on the next meeting. And this is actually 97.9. Like, this is conviction. This is some conviction in the market, right? This is some conviction in the market. So that is the federal funds rate. And then let's take a look at the June meeting. How are they pricing in the June meeting? So they also think that rates are going to stay the same in June with a higher entry. Wow, the market is legitimately pricing in rate hikes. This is a this is definitely a reason why we're seeing a sell-off in the market right now. So even up to July, let's see when it flips. When does the market think that we're actually going to get a rate cut? And just so you know, this is data that's compiled from like actual traders in the market. And it's this CME group. These numbers are a very accurate representation of what the people in the market, like market participants, are thinking. So this is very interesting. So even up to October 28th, they still think we're not going to get a cut. What about December? 3.5. December is when we're getting the first, or is when the market thinks the first possibility of a rate cut, and it's such a low chance. 3.4%. And then, wow, the market, we might be going real low. We kind of just started seeing the starts of the sell-off. I wonder how bad next week is actually going to get. I wonder how bad it's going to get. So that being said, let's see what catalyst we can look forward to see how it can affect. Okay, so on Monday, we're getting the federal chair, or the chair of the Federal Reserve, Powell. He's actually going to make a speech at 7:30 in the morning. This is going to be very important in terms of because like what he says is going to be, what he says is definitely going to influence the rate decision. And if if he basically confirms what the market is thinking, that we're not going to get a rate cut until next year, then I can see how the market sell off even further. I can see that happening. But let me go back here real quick. So, all right, we got Chair Powell speaking on Monday, 7:30 in the morning, and then we got JOLTS job openings. This is another labor market indicator. JOLTS just stands for job openings and labor turnover survey. So job creation is an important indicator, leading indicator of consumer spending, which accounts for a majority of overall economic activity, like I was saying. So they expect 6.95 million, and they expect a drop in the forecast. So that means, depending on how this number actually comes out, can be a determining factor in Fed decisions. Also aligned with what Powell says. So that's on Tuesday. Let's see, Wednesday, retail sales. Another, this is not really a labor market indicator, but this is, retail sales. I think this is a number that comes from the actual businesses. So we could read it here. Changing the total value of sales at the retail level. Earliest and broadest look at the vital consumer spending data. It's the primary gauge of consumer spending, which accounts for the majority of overall economic activity. So, I think you want to see an increased retail sales. Yeah, you actually want to see an increase. So the market, or the analysts are actually forecasting an increase in retail sales. So we'll see how that comes out on Wednesday. Thursday, another labor market indicator, unemployment claims. So we'll see how that turns out. Previous number is 210. They expect more people to be filing for unemployment. So, not necessarily the best thing for Not exactly the best thing for the labor market. Holidays, and then on Friday, bank holiday. What holiday is on Friday? Oh, Good Friday. And then we got NFP. NFP is, I don't have to explain our NFP. You could just read it. All of this stuff, if you want to understand a lot more in depth of the things I'm talking about, you can really just get my course, and I explain all of these things and all of these indicators and how you can look them up, how you can use them in your analysis, and you can actually better follow along with what's going on. But yeah, so finishing this up, unemployment rate, so they actually expect that to remain flat, which is very interesting. Very interesting. So this is the data we have looking forward to on next week. And let's just finish this up by just looking at some charts. Just checking my notes here. All right, so one thing we didn't talk about first is commodities themselves. So we already talked about earlier how energy is going higher. And it's because of the situation going on with the war. So you can actually see that here. You can actually see it visually on the chart. Oil is up 7% today in one day, which again, very volatile, very volatile. And if we just look at how it's going, it looks like it wants to continue even higher. But like we said, like I was explaining earlier, if the Strait of Hormuz stays closed, yeah, we're gonna see higher oil prices. Higher oil prices means higher gas prices, higher energy overall. You know, not good for the economy. Not good. No good. No bueno. So that's oil. I mean, let's see. To be honest, I can't even put. We can't even say like this is a resistance level. Just because with certain commodities, especially like oil, um, especially after my years of like learning trading and attempting to trade oil and stuff, there's a lot more geopolitical factors at play than just the technical analysis on the charts. So it's like we can look at it, and this is specifically for oil, specifically for commodities. There's a lot more geopolitical factors at play. Like just a brief overview here, right? Like oil dropped. This is back in 2020, right? Oil literally went negative. Like you can see, I don't think it shows it on this chart, but like look at this, 13 cents for a barrel of oil, right? And this is because the supply chains got shut off during the COVID lockdown, right? But now just think of the timeline here. 2020 supply chain shocks, oil's at zero. What happens in 2022? The Russia-Ukraine war. And then now oil goes from 64 cents to 13 cents a barrel to 129 cents a barrel. And we're talking about a 20,000% gain in the matter of 2 years, right? So there is ways to invest into long term for energy. Oil is not one of them. Oil is not something you should buy in your account and just hold on to it forever because no, just no. There's too many factors at play to be able to hold it for the long term and it makes sense. But anyways, one thing we definitely can expect is higher oil prices going forward. It's one thing we'll definitely expect. Question is, it's gonna be like the opposite of limbo. Like, how limbo is like, how low can you go? How high can you go? Oil, like, how high can you go? I have no idea, but it can go pretty damn high. So that's oil, and then we got our precious metals. So let's take a look at gold. Gold, safe haven asset. Historically, and with all of the geopolitical risks and all of the things that's been going on, you can kind of see how gold kind of just went parabolic ever since 2020, or I think really this is like 2022. You see this low here of like 1,600 per ounce of gold. But like, if you were a gold investor since 2022, you are sitting pretty right now. You're up. You're up at least 175% if you got in at the lows. But like gold, it hit a slight resistance level of what was that 5,500, and it started selling off. So this is the monthly chart. Let me go back to the daily chart. So you can see here, gold is actually coming back up. So we kind of had a liquidation. This is probably people just big money taking profits. To close the trade, you sell, sell it off a little bit. But now, again, with all the geopolitical risk and uncertainty that's going on with the war, investors are piling back into gold. So I can expect this to continue bullish and probably break this high. I don't know when this is gonna happen, but I can kind of see that that's how the trend is going on right now. And then yeah, so precious metals, and then natural gas. Energy overall is bullish. Always a bull market somewhere. But let's go back into these indexes real quick just to finish it up. And let's see how, oh, and the VIX is at 31. The volatility index is at 31. That's also very exciting, up 13% on the day. And then let's take a look at the S&P and the US 30 are they move very, very similarly. I'm just going to take a look at the S&P and the NASDAQ. But let's see, do a quick technical analysis here. So we got our EMAs. Let's put on, these are my short-term EMAs. Let's put on this one. All right, so 50-day moving average. You know what? Let me also add another one. This is also another thing that a lot of traders look at. Is it the 200 EMA? Which, if you don't know, EMA stands for exponential moving average. Hold on, why is it not? EMA. Yeah, moving average exponential. I remember now. I have to adjust it to myself. So you click on it, settings, put this to 200, and then just change the thingamajig so you can actually see it. Okay, cool. This is kind of what we have going on. This is on the weekly chart, so you can see we kind of confirmed closing below that 50 EMA chart. But this is a weekly chart. Just kind of looking at it. I mean, if I had to bet on if the price will be, if next week's close, if I had to bet on if it's going to be higher or lower from this point, I'm going to bet lower. It's like I could be wrong. Like I don't know. I could be wrong. But let's take a look at the daily chart. And yeah, so we're seeing, oh, we're actually below the 200 moving average. Oh, that's not a good sign at all. On the daily, from the daily perspective, we're actually below this 200 moving average. So I'm trying to see what can be like a key level. Well, according to just basic technical analysis here, this was a previous support level. This is a previous support level. You can see the market bouncing multiple times off of here. It retested once, retested twice, retested 3 times, and then it went. So this is a key level that you would want to look out for. If the market can kind of stay above here, or if it reaches here and it bounces and it shows like some actual support, maybe that could be a trade confirmation for you to go long. And let's see, the next key level at that point is kind of just the psychological level of 6,000. So I would say around here. These are some reasonable, I would argue some reasonable buying opportunities for the long term. to specify that. If you want to hold on to this for at least you know 2 years or so, these wouldn't be some bad areas to buy in my humble opinion. So I think that is pretty much gonna summarize this first market review. Let me know how I did. Um, Always trying to make this content as information as possible, because make education great again, I guess. But yeah, let me know. Have any comments? If you want to see anything more specifically, we can take a deep dive into it. But that's it for me. Hope you guys have a good one. See you on the next one.